The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, how are you doing? How is the summer treating you?
Hey there, Ian. Great to chat. Now, this has been an unexpectedly busy week. We've had results and updates and news of a potential new IPO for London. At the same time, if we step back, it's coming into the end of H1. So I did a quick look in terms of valuation for the tech sector. Good news, PE flatlining at 17.6. But the actual good news is that there is absolutely a bit of pep in the market. So looking at TechMark Index, this is now up year to date 9.6%. Of which the vast majority occurred in the last couple of months. Interesting warning signal for both of us. Bessemer Cloud is still down. Now it's recovered a little bit, but it's down 6% year to date. That's America and it's cloud, of course. FTSE small cap is up 4.2%. But I'd like to sort of park all of that at the moment. We had a breaking news story last night that Visma is thinking about listing in London. Any ideas to help the investor community on Visma, Ian?
Well, it's like Sage, but it's different. That's the best way to think of it. Every time you think you know about this and everything you understand, and every time you draw a comparison to Sage, you'll be wrong.
Now, once upon a time, when I say once upon a time, I mean specifically 2006, Sage tried to buy Visma. So is it that it was like Sage, but then got very different? Or is it that everyone has been confused, including a potential buyer?
They were on similar paths, should we say, in the middle of the decade before. And one of them pressed the accelerator and the other one didn't. And the accelerator that Visma was pressing was both the move to cloud and also, courtesy of its owners, HG, the acquisition trail. Whereas Sage has been a little bit more pedestrian. It's still made good progress, though, but it hasn't been lots of small acquisitions. It's been a couple of chunkies and infills around the edges. Whereas what we are looking at with Visma is very much a business that is being driven hard by HG. It's not sexy, high-end, bleeding-edge stuff in any way, shape or form. It is about M&A and execution. And at the end of the day, if these guys are going to take any reward out of it for what they've done with Visma, it's not for technology genius. It's not for inspirational views of the way the world is working. It's really for just the damn hard work they've done in going out and finding things to stick into this business.
I mean, it's sort of functionally, it does accounting, payroll, HR software. It's got 16.4K employees, so a little bit more than Sage, 2.1 million customers. The small business is 34% of revenue. You're right, it's made a far better fist of the whole desktop to cloud migration.
40% margins, EBITDA margins in the small business as well, which might make Sage think a bit in terms of their ongoing investor meetings when people start prodding the desk to say, why aren't you growing as fast? Why aren't your margins as high in this area?
That's a super point, Ian. I don't know if we should sort of stop the track that we're on in discussing Visma and say, whoa, what's Sage going? But let's, for the time being, just concentrate on Visma. You said HG is the owner, so M&A playbook. They did 33 acquisitions last year, but the company isn't rolling in debt. Net debt EBITDA 2.4 times. So that obvious problem isn't there. Now, there is one in terms of PAT, because PAT gets stumped by interest payments, which are quite high. So I would imagine that in investor meetings for Visma, people are being encouraged to look at, as you said, that stunning EBITDA number, but also free cash flow and free cash flow yield, I would imagine.
But a lot of that, in fact, all of it last year, just went straight out the door on acquisitions, which
Yes.
for me, for the accountant, but of course you'll come in with a riposte as to what the organic growth rate actually was, which took me back.
So in fairness, the underlying organic growth was 11.9%. Headline was 17.3. As we both know, Sage has been popping out at sort of 10% underlying organic. So that's what this sort of market feels like. As an investor looks at this, a bit like HG, one of the things you'll ask yourself is, who will buy this from me? So who's the last person in the chain? So where does Visma go? How will an investor see it that way? Will they see this as something that pops on the market for a few years, possibly pull back from an M&A perspective, think more about shareholder returns, so we might see that one come along? Or would it in itself become an acquisition story for somebody else? Any views there, Ian?
Well, it's almost the case of who did I last try and sell it to, or who that I've tried to sell it to in the last 8 years, whatever, has now forgotten about it or will now have a fresh look at it. Particularly when it did a fundraise a couple of years back. It's not
Yes.
as if the other private equity guys haven't had a look at it. It's not in the HG playbook to keep everything to themselves all the time. I think that is going to be the issue that fund managers are going to look at and say, well, if we aren't going to keep funding this, how fast are you going to grow? And if we're not going to keep funding it and we're not having a growth story, what's our turn on this? Are you just parking this in a market for a couple of years? How much are you actually going to sell yourself of your shareholding? Are you just going to structure this to get your 19 billion euro valuation so you can point to that for your fund valuation, despite having only sold 15% of your holding of the company? Maybe I'm being a little bit cynical about this, but there are those kind of questions are going to be asked. And that comes back to the sort of whole public versus private equity debate and how we do valuations and how we look at growth going forward.
But also, isn't it about how private companies are run and managed? Is there not a stronger go for growth story from that constituency, which maybe there isn't in the public market, where at the moment everyone just wants to buy back their own shares?
Yes, you can't really imagine HG just sitting there saying, we want cash out of this, because quite clearly that isn't what they've been demanding over the years. And that is what has resulted in this business. As you say, back in 2006, it was, oh, should Sage buy or should Sage not bother? Well, the two companies are now looking at the same valuation.
I'm reminded of your work on Constellation. Investors who bought these larger IPOs, say, I don't know, Darktrace or Sophos, you've got clear line of sight of who the trade buyer is. Do you see someone like a Constellation coming in for Visma in a couple of years' time?
It's too expensive for Constellation. I think the temptation as far as the Constellation story is to, this is another Constellation, but the model is different. They're paying higher prices. They are doing more integration work. They're not totally integrating everything, clearly. It's not that great a scaling a business. If we look at metrics such as revenue per head, that's a little bit of a disappointment. But I don't see that there's an obvious buyer other than Thoma Bravo, if they're bored with sitting around on too much of their next big European focused fund, however big that is going to be.
Timing plays well for them for next year because we've got regulation hitting this sector again, and everyone has to have accounting software to file their returns. So that'll create a little bit of interest in the market, possibly even goose up organic growth rates in the UK. You talked earlier about one of the implications of Visma being at Sage, there might be some finger pointing or navel gazing at the moment. What's your thinking there?
To be the ultimate cynic, when you offer a UK fund manager, here's a new alternative for your risky holding in technology, are you just going to say, well, I'll put this all into this nice, fresh, exciting looking one that might ramp up over the next 18 months with sort of some legacy flow-through growth from recent acquisitions that we've been promised will have some effect from the brokers, and therefore take the money away from Sage and investment into UK technology people, technology companies? Completely counterproductive, but I think that's perhaps an excessively cynical view of things, even for me.
Cynicism lives here, so you're okay. You're amongst friends. Not to be too cynical, though, you did sort of talk around sort of the dynamics of PE ownership. And I think you were given another illustration of that this week, seeing the guys and gals at IP Group. How was that in terms of compare, contrast? How are they putting their portfolios together? What's the shape of them?
Yes, this is very much the other end of the spectrum to HG. IP Group, two real parts of the business. The first is the chunk, which is a venture capital fund mainly investing in B, C, D stage, deep tech, technology transformation, life sciences, clean energy transition businesses. And then it also has fund management businesses in the form of Park Walk, which is heavily invested in running funds which invest in early stage spin out businesses from universities, which is a great way in which to get involved in finding out about new technologies. Not that they necessarily feed those investments from the Park Walk funds all the way through the storyline, all the way through to B, C, D, and E, and maybe even beyond in the main IP Group portfolio. And then it also runs some pension fund money, notably in Australia, which is typically investing in later stage stuff, but nothing of the sort of maturity that we see HG getting involved with. They had this investor teach-in day yesterday. I found it great. I know that's shocking to some people that I might find anything quite so positive, but it was hugely positive. People were talking with great enthusiasm about what they were doing, where the technology was going, the solutions they were going to provide, and how that was going to drive growth, both to their own companies, to the portfolio, and to the wider economy. Yes, the stocks trades at a significant discount to NAV, but the mentality, the long-term view that these guys have, it was refreshing to see how they could look through that and say, okay, we can see what's going on, but we know what happens at the end. We know we are fundamentally exposed to long-term stories here. And part of what they were trying to do in the companies from their portfolio that they were presenting was to try and say, stop looking at what's in our portfolio that you can see short-term news flow about. Look at these big chunks of our portfolio that are going to drive change over the 2, 3, 4, 5-year view, because these are the ones that are going to have the big value. And stop yourself looking at the minutiae and looking at too many numbers, because you're not going to get anything out of the detail because the detail's not right, as it were.
Yeah, but remembering our HG lessons, they too will be conscious of their exit. Were they clear? Did they give any clarity on what exit looked like for them?
Exits are typically from this space, they are going into larger enterprises.
Right, yeah.
IPO was not mentioned other than in sort of peculiar historic concept and references. You have to remember that IP Group, it came to the market as IP to IPO. That's where its roots lay. It was just hugely positive. But what was disappointing, although there were a good number of people there, it was very much sort of sit back and listen. And the level of engagement was perhaps a little bit frustrating from the fund manager analyst side of things. I feel that it gets looked at sort of, oh, it's at a discount. Is this a value proposition? I'm not sure if you go into that room with value proposition going around your head, you're actually going to come out, no matter what the value proposition is, feeling really as if that's a big discount, because you don't actually get your head round the growth prospects of it.
I was going to remind myself of comments you've made in the past. Given the focus of the fund there, these are early stage, hard to get your head around companies. Do I understand and know enough about the underlying growth drivers to the business rather than the KPIs that they've just produced? So this is not easy territory. And is there to some extent, I'm really outsourcing the decision here to a team that I think can create shareholder value?
To a large extent, yes, because they are putting in front of you a portfolio,
Yeah.
and you listen to them, you look at their track record, you understand how they think about companies, how they get involved with the progress of the companies and the technologies, and how they are involved across the whole UK intellectual property universe, through all the universities, through doing all the various funding rounds where they see people come to them. Okay, they may push back on a lot of stuff, the vast majority of what they see, but they are sort of at the center of deal flow for this deep tech market.
And I would imagine, given their name and brand, they probably see enough of the deals coming through. Did they make any comment at all about the amount of dry powder in this sector?
Their commentary relating to this issue was about the scale up and the level of scale up funding in the whole UK market. And this was one of the things that has come out recently from the various studies, that we've got plenty of money going into the sort of EIS, seed, pre-seed market, A round, not so much the B round. And by the time you get to sort of C, D, E round, we're starting to thinking, actually, even though at that stage we have plenty of more mature businesses and they are still working, it seems, we aren't just not getting the funding flowing through to that. And that is when you look to the hallowed Mansion House Accord, that would be really where Rachel Reeves's objectives are, not in pumping up some mundane rubbish that's floated on the UK Stock Exchange 40 years ago and hasn't done anything of any merit since.
Ian, you went, you were enthused, you were inspired by a whole series of presentations in the afternoon, and you got on the train. Did you then get a little bit maudlin as you thought one of the key differences between the private companies you're seeing and the public market companies is growth? The private companies just do it better. I was at an event this week. We were looking at 76 private companies. These are UK tech companies pretty much across the tech universe. And their average growth last year was 37.6%. If we look to the UK, professional services group, 1% growth, UK software, 7.6% growth. So there is a chasm in terms of growth. And then when we see our public companies, we get an ongoing saga of share buybacks and sort of to some extent making themselves more illiquid. Or so I thought. And then this week we had Dotdigital.
Yes. Well, this circles back to the idea of, are they being allowed to grow to a certain extent? And before we enter Dotdigital land, I think there was an interesting reference that IP Group management made to remuneration of investors as bodies, as enterprises, in other words, fund management companies, VC companies, saying that we take fees out of this and they're not 0.5%, 1%, 1.25%. They are substantially greater than that. And the reason we do that is we are producing returns significantly ahead of what you might expect from the stock market over the cycle, but we are also doing a lot of work for that. So that has to be remembered. And I think that sort of cycles back into why are UK public companies not being allowed? If the fund manager isn't allowed time or can't afford to do the homework, doesn't have the resources, whether that be in-house or externally, in other words, equity research, they're not going to take on any risk. They're just sitting there with this 45-minute presentation, somewhat limited resources. And there are many things that have happened over the last 15, 20 years, one of which is the nature of research. And I don't think it's in the slightest bit helpful the way in which that fund managers just don't have the resources to do the work required to say to companies, go out and take this risk. If fund managers get scared at 1.5 times net debt to EBITDA, then we have a problem. And going back to not too many years ago when I was doing my glorious startup in the investor relations space, the whole feedback, response after response about what is the right level of debt was, oh, yes, it's net debt, about 3 times cover, or net debt, 3 times debt to equity. Well, that's scary. And then when you challenge the fund managers to why anything would be an appropriate level of debt, no answer, because they just run away.
I'd also say that there's a degree of groupthink. If this is what the other people are doing, then I need to do it as well. Otherwise, I'll be perceived as an outlier, and then goodness only knows what's going to happen. But to circle back to Dotdigital, they're not just all doing share buybacks. We had an acquisition this week from Dotdigital.
Yes.
Any thoughts on Dotdigital?
I think we've touched on this one before, and are sort of trying to work out, yes, you've got a nice enough business. You've got some pretty reasonable margins there. You don't have the growth that we might like you to have when you talk about the area and the whole sort of customer engagement, communication, information gathering.
It's a tough space, though.
It's a tough
IBM's
space.
bought stuff, Oracle's bought. There are big, ugly companies hanging out here.
But we should be in these sort of small, medium-sized, or slightly larger, medium-sized enterprises.
Hang on. Are we back to Visma, Ian?
we're back to the fact that the whole sort of...
There are markets where the biggies won't be there. Very good point. Very good.
But are these guys spending enough on these markets in terms of marketing? Because they've gone out and they've bought this business, Snowball Social, for $35 million, of which 20 is up front. It's all about coupons, and they saying Shopify, but really it's also about the whole TikTok engagement of people who recommend that you go and buy this, and here's a token number, and someone will get remunerated and someone will get a discount and someone will get some information feedback out of it all.
So that part of the story stacks up. That is a real active in terms of affiliate and referral program marketing. There's a huge industry in there. Isn't it nice to see Dotdigital play some role in it?
It is, but is it really a $30 million deal that's required? Is it really that difficult a piece of coding to write? Are you actually buying a set of customers that you couldn't have acquired through aggressive marketing? Certainly,
I think you've answered your own question, because you said earlier one of the challenges for Dotdigital is marketing.
Yeah.
And here somebody has done that hard graft. So I agree with you. It's not the lines of code that they've acquired. It's the customer base. It's more influencer marketing.
Yes. And are those really the companies that quite tie in with their existing customer base? I feel they're probably a bit smaller than their existing customer base. And how many of their existing customer base were already looking at this with other providers already?
Okay, so that's a hard question, because this isn't a new market. This has been around for quite a while. Agreed. Maybe it's the industrialization of it is the new bit for them. I understand that Social Snowball has 1,500 or so active subscription customers. So there's some scale, some presence, some footprint in this area.
We would have said that about transactional SMS a couple of years ago. This is all taking off, but where is it going as far as margins are concerned?
No, but worse, when you mentioned it earlier, you said this is really coupons, and that is the harsh truth here. This is modern coupons.
Yes.
And that just creates all sorts of concerns in terms of the moat for this particular business.
I worry that this business is increasingly looking like it's having to paddle away beneath the surface, disguising M&A as belated marketing and technology development.
But I'm glad that they have made an acquisition into this space, because without them being there, it just felt like a gap in terms of their armory.
Yes, but how much to fill the next gap? Which I know is a bit of a flip around on my position on this company. The price tag makes me wary, should we say.
Yeah. In addition to the acquisition, they also popped out trading update in line with market consensus. They had a little bit of a wobble with the legacy contract, non-renewal, but otherwise trading was okay. Ian, did you see S3 this week?
I'm afraid I did not.
They were a bit better than Hayes, broadly in line, but clearly, once again, from the recruitment sector, a narrative of decline. So net fees there were down 14% year on year. We also had a busy week in terms of IT professional services. From Made Tech, a statement of year ending ahead of expectations. So that was positive. And TPX Impact also ended ahead of expectations.
Their markets have stabilized. They are onward and up.
Sort of the customer, i.e. UK public sector, seems to have a better sense of itself. New team just takes time, shunting job roles, chairs, priorities. But I think the big picture around AI-enabled services to improve the service that you and I as citizens receive for a cheaper price, I think that is the goal that they want to head to. And in addition, there seems to be a positive buying environment for UK SMEs. We're back to Visma again. How did we do that? Ian, on that bombshell, everything's about Visma. Thank you very much. Have a glorious weekend in the sunshine.
And you.
Brought to you by Progressive Equity.